I want to tell you about something that's happening right now across two continents that will fundamentally reshape global power. It's not a war, it's not a treaty, it's something far more consequential. And if you're not paying attention, you're missing the most important economic story of our time. In the past 18 months, something extraordinary has occurred. Kenya announced it would pay for oil imports from Saudi Arabia and the UAE in Chinese yuan. Brazil and China agreed to settle trade in their own currencies, bypassing the dollar entirely. Argentina is now considering using yuan for trade with China. The UAE, Saudi Arabia's closest ally, opened yuan clearinghouses in Abu Dhabi. Egypt secured a $7 billion currency swap line with China. Nigeria is exploring UN-denominated trade agreements. One by one, countries across Africa and the Gulf are making the same calculation, the same quiet decision. They're slowly, carefully, deliberately reducing their dependence on the American dollar. Now, you might think this is just currency diversification, normal financial management, countries spreading risk across multiple currencies. But here's what makes this different, what makes this Washington's worst nightmare coming true. This isn't random, this isn't coincidental, this is coordinated, this is strategic, and it's accelerating. Let me explain why this matters more than almost anything else happening in geopolitics right now. And I should warn you, once you understand what's actually at stake, you'll realize that we're watching the foundation of American power slowly crumble, and most people don't even know it's happening. Let's start with a basic question. Why does it matter what currency countries use for trade? If Kenya wants to buy oil in yuan instead of dollars, so what? They're still buying oil. The transaction still happens. What's the big deal? Here's the big deal. The dominance of the dollar in global trade isn't just convenient for America. It's the source of enormous power, power that has shaped the world for 80 years, power that's now under threat. When countries need dollars to buy oil, to purchase commodities, to settle international debts, they have to hold large reserves of dollars. To get those dollars, they export goods to America or sell assets for dollars. Those dollars then get invested back into American assets, treasury bonds, stocks, real estate. This creates constant demand for dollars and for dollar-denominated investments. This is what economists call the exorbitant privilege. America can print dollars and the world accepts them as payment. The United States can run massive trade deficits, buying more than it sells because other countries need and want dollars. It's like having a credit card with no limit that everyone is happy to accept. But there's more. Dollar dominance gives America extraordinary geopolitical leverage. When the United States imposes sanctions, it can cut countries off from the dollar-based financial system. No access to SWIFT, the messaging system that moves money between banks globally. No ability to trade with most of the world. No way to buy oil or food or medicine in international markets. This is what happened to Russia after they invaded Ukraine. The United States and Europe cut Russian banks off from SWIFT, froze Russian dollar reserves held in Western banks, made it nearly impossible for Russia to engage in international commerce. It was economic warfare without firing a shot. And it worked because the dollar is the global reserve currency, because most international trade happens in dollars, because most countries need access to the dollar system to function. But what if they didn't? What if countries could trade in other currencies? What if they could bypass the dollar system entirely? Then American sanctions lose their teeth. American leverage evaporates. The exorbitant privilege ends. That's what's happening now, and it's happening in the two regions that matter most for the dollar's dominance, Africa and the Gulf. Let's talk about the Gulf first, because this is where the dollar's dominance was built. In 1974, the United States made a deal with Saudi Arabia. The Saudis would price oil exclusively in dollars. They would invest their oil revenues in American assets. In exchange, America would guarantee Saudi security, provide weapons, and maintain regional stability. This was the petrodollar system. Every country that needed oil, which is every country, needed dollars to buy it. This created permanent global demand for dollars. It meant that as the world economy grew and needed more energy, it needed more dollars. The petrodollar system was the bedrock of dollar dominance. For 50 years, it held. Saudi Arabia priced oil in dollars. The UAE followed suit, Kuwait, Qatar, all the major Gulf producers. Oil flowed one direction, dollars flowed back. The system seemed eternal. But in March 2023, something changed. Saudi Arabia and China discussed pricing oil sales to China in yuan, not as a complete replacement for dollars, just for Chinese purchases. But the symbolism was enormous. The Saudis were publicly considering breaking the petrodollar monopoly. Think about what that means. China is the world's largest oil importer. They buy more than 10 million barrels per day. If even half of that trade shifted to yuan, that's billions of dollars per day in demand for yuan instead of dollars. And it's not just the direct trade, it's the ripple effects. If Saudi Arabia accepts yuan for oil, those yuan need to go somewhere. Saudi Arabia would need to invest in yuan-denominated assets, Chinese bonds, Chinese stocks, Chinese infrastructure projects. Money that previously flowed automatically to New York would flow to Shanghai instead. The UAE has already moved. They've established yuan clearinghouses. Abu Dhabi Global Market now settles transactions in yuan. The UAE is positioning itself as a bridge between Chinese finance and the Middle East. They're hedging their bets, maintaining relationships with America while building new ties with China. And the Gulf states have good reasons for this shift. China is now their largest trading partner. Chinese demand for oil dwarfs American demand. America's energy independence means they need Gulf oil less than at any time in 50 years. Meanwhile, China offers something America doesn't. Massive infrastructure investment, no political conditions, no lectures about human rights or democracy. The Belt and Road Initiative has poured hundreds of billions into ports, railways, power plants across the Middle East. Chinese construction firms are building entire cities in Saudi Arabia. The economic logic that sustained the petrodollar is reversing. Now let's turn to Africa, because this is where China's yuan push is spreading fastest and where the implications are most profound. Kenya's decision to pay for oil in yuan wasn't isolated. It was part of a broader pattern. China is now Africa's largest trading partner. Total trade between China and Africa exceeded $280 billion in 2023. Chinese firms have invested over $300 billion in African infrastructure over the past 2 decades. Roads, railways, ports, power plants, telecommunications networks. But it's not just infrastructure. China has extended billions in loans to African governments. And here's where it gets interesting. Many of those loans are denominated in yuan. When countries borrow in yuan, they need yuan to repay those loans. That creates structural demand for yuan, just like dollar-denominated debt created demand for dollars. Let me tell you about what's happening in Zambia, because it illustrates the mechanism perfectly. Zambia borrowed heavily from China to build roads and power plants. Those loans are in yuan. Zambia exports copper, their main commodity. Traditionally, they'd sell copper for dollars on international markets, then convert some dollars to yuan to repay Chinese loans. But there's a more efficient way. Sell copper directly to China for yuan, use those yuan to repay the loans. Skip the dollar conversion entirely. Lower transaction costs, less currency risk. Makes perfect economic sense. Now multiply that across dozens of African countries, each one with Chinese loans. Each one exporting commodities, each one making the same calculation. Trade directly with China in yuan. The dollar becomes unnecessary for a growing portion of their international commerce. And it's not just bilateral trade with China. Chinese digital payment systems are spreading across Africa. Alipay and WeChat Pay are expanding. Mobile money platforms are integrating with Chinese systems. Young Africans are using Chinese apps, Chinese platforms, Chinese financial infrastructure. This is the ground game of currency dominance, not just big trades between governments, but millions of small transactions that create habitual use, that build infrastructure, that make one currency familiar and another currency foreign. Nigeria, Africa's largest economy, is exploring this path. They're discussing yuan-denominated trade with China. They're considering joining the BRICS currency initiative. They're looking at Chinese payment systems. Nigeria imports massive amounts of goods from China. Electronics, machinery, textiles, paying in yuan instead of dollars would save them billions in conversion costs. Egypt has gone further. They signed a currency swap agreement with China worth $7 billion. This allows Egypt to borrow yuan directly from China's central bank and repay in Egyptian pounds. It's a financial lifeline that doesn't run through Washington or require dollar reserves. Think about what happens when these arrangements multiply, when Kenya and Egypt and Nigeria and Zambia and Angola all start using yuan for significant portions of their trade, when the Gulf states accept yuan for oil, when countries discover they can trade, invest, and borrow without needing dollars. The demand for dollars decreases, not overnight, not completely, but gradually, persistently, structurally. And when demand for dollars decreases, several things happen. First, the value of the dollar declines. If fewer countries need to hold dollar reserves, they sell dollars and buy other currencies. The dollar weakens. This makes American imports more expensive. It reduces American purchasing power. It makes that trade deficit harder to sustain. Second, demand for U.S. Treasury bonds decreases. If countries aren't accumulating dollars, they don't need to invest those dollars in treasuries. Remember, foreign holdings of treasuries are already declining. Japan and Saudi Arabia are selling. If African and Gulf nations start holding yuan reserves instead of dollar reserves, that's hundreds of billions less in treasury demand, and the U.S. government needs to sell trillions in treasuries every year. If foreign demand drops, interest rates have to rise to attract buyers. Higher rates mean higher interest costs. The debt spiral accelerates. Third, and most importantly, American geopolitical leverage erodes. Sanctions become less effective. If Russia can buy oil from Saudi Arabia in yuan, if African countries can trade without dollars, if Chinese payment systems provide alternatives to SWIFT, then cutting countries off from the dollar system doesn't paralyze them anymore. Let me give you a concrete example of what this means. In 2023, the United States threatened secondary sanctions against any country buying Venezuelan oil. The threat worked because those countries needed access to the dollar system. But what if Venezuela starts selling oil to China for yuan, and China pays using digital yuan through systems that don't touch American banks? The sanctions become unenforceable. This is Washington's nightmare, not a sudden collapse, but a gradual erosion. A world where the dollar is still important, but no longer indispensable, where countries have alternatives, where American economic pressure can be circumvented. Now, before you think this is inevitable or imminent, let me be clear about the obstacles China faces. The yuan is not ready to replace the dollar as the global reserve currency, not even close. First, China maintains strict capital controls. You can't freely move yuan in and out of China. That makes it less attractive as a reserve currency. Countries want to know they can access and use their reserves without restrictions. Second, Chinese financial markets aren't as deep or liquid as American markets. If you're holding trillions in reserves, you need somewhere to invest them. U.S. Treasury markets can absorb trillions. Chinese bond markets aren't there yet. Third, trust matters. The dollar is backed by American rule of law, independent courts, property rights. China is an authoritarian state where the party controls everything. Many countries are wary of becoming too dependent on China. Fourth, the network effects of dollar dominance are powerful. The entire global financial system is built around dollars. Banks, software, contracts, habits. Changing that is like trying to replace the QWERTY keyboard. Even if there's a better option, the switching costs are enormous. But here's what worries me. China doesn't need the yuan to replace the dollar. They just need it to provide an alternative, a parallel system, a way for countries to reduce dependence on dollars without abandoning dollars entirely. And that's exactly what's being built, slowly, carefully, country by country, trade agreement by trade agreement. In Africa and the Gulf, the regions where dollar dominance was most entrenched, alternatives are emerging. China is offering something America can't or won't match: infrastructure investment with no political conditions, development loans without IMF austerity requirements, trade relationships that don't come with sanctions threats, and increasingly a financial system that works independently of Washington. For African countries tired of being lectured by the West, tired of sanctions and conditions, tired of structural adjustment programs. The Chinese model is attractive. You might not love the Chinese government, but they build roads that work and they don't tell you how to run your country. For Gulf states watching America pivot away from the Middle East, watching renewable energy threaten oil's long-term value, diversifying away from exclusive dollar dependence makes strategic sense. The momentum is building. Each country that signs a yuan trade agreement makes it easier for the next country. Each clearinghouse that opens in a new city extends the network. Each loan denominated in yuan creates structural demand. This isn't happening in a year, maybe not even in a decade, but the direction is clear. The trajectory is set, and Washington is watching its worst nightmare unfold in slow motion. Because dollar dominance wasn't just about economics. It was about power, the power to sanction enemies, the power to fund deficits, the power to shape the global order. That power rested on everyone needing dollars. And now, increasingly, they don't. Or at least they don't need them as much. They have alternatives. And alternatives are the beginning of the end of monopoly. I don't know how this ends. Whether the dollar remains dominant but diminished. Whether we move to a multipolar currency world, whether China's yuan eventually challenges dollar supremacy directly. But I know this, the world that emerges from this shift will be fundamentally different from the world we've known. American power will be more constrained. American leverage will be reduced. The exorbitant privilege will fade, and it's happening now in Kenya's oil payments, in Saudi Arabia's yuan discussions, in Egypt's currency swaps, in Nigeria's trade calculations, in 1,000 small decisions across Africa and the Gulf. Washington's worst nightmare isn't a sudden crisis. It's this slow, steady erosion. The ground shifting beneath our feet while we pretend everything is stable. The yuan push is spreading, not because China is forcing it, but because countries are choosing it, because the math makes sense, because alternatives have value. And once alternatives exist, monopolies don't last. The question now is whether America adapts to a world of competitive currencies and shared power, or whether we resist until the shift happens anyway, but on terms we don't control. Because ready or not, the petrodollar era is ending, and what comes next will define the 21st century.